this half hour. Fixing America's crumbling infrastructure. The nation's roads, bridges, airports, and railways are in such a state of disrepair. The American Society of Civil Engineers estimates the U.S. would need to invest some $4.5 trillion by 2025 to improve them. Where can we come up with that kind of money? The co-founder of one of the nation's leading container leasing corporations has an idea. Marthin Tuchman's proposal: cut the tax rate on U.S. companies repatriating profit from overseas from the current 35% to 5%, but require them to use 25% of that cash to buy municipal bonds from states. Joining us now for more on his plan, co-founder of Interpool, chairman and CEO of the Tuckman Group, Marthin Tuchman is here. Marthin, thanks for being here this morning. Good morning.
Good morning.
So do you think that companies would be on board with your plan?
Well, I think they would. We did this once before. In about 12 years ago, there was a Jobs Creation Act, and there was a one-year window where those companies that had money offshore could repatriate the money and only pay 5.25%. We were one of the companies that did that. We brought over about $300 million at that time. It was a lot of money for us at that time. And so we know it works as far as getting corporations to sign on. The problem last time was not everybody abided by the so-called rules. They did not put the money back into the infrastructure. They didn't create jobs. They paid dividends, did stock buyback programs, all the wrong things that you would want to do to sell a repatriation program. The difference this time, I believe, you still go along with the 5.25%, but you mandate that 25% be for municipal bonds. And this places the decision in the hands of the governors of the states, because they're the ones that are running the states. They're the CEOs, and they have the discretion to invest that money into the projects that are necessary.
It's an interesting plan, Marthin, and a well-thought-out one. Does it imply skepticism over the Trump administration's $1 trillion infrastructure plan, which would have around $200 billion from federal monies, $800 billion from states, municipalities, and private investors? It just, if you reference Wilbur Ross's October 2016 comments, in order to fund these projects, you need to ensure investors that you're going to have repeatable revenue, cash flow to meet your debt obligation, as well as supply dividend to the equity.
Yes, well, I agree that there's a lot of plans floating around. The one thing we have to keep in mind is that if there is, in fact, $2 trillion that gets repatriated, under this plan, $500 billion would go into the rebuilding the infrastructure, also creating jobs. You have to remember, infrastructure is not something that can be outsourced. It has to be done in the United States. And the jobs that will be created will be good jobs: engineers, construction workers, electricians, teamsters. It's, in my opinion, will be very much supported by the unions and the workers.
So you mentioned, excuse me,
go ahead, Steve. Go ahead.
You mentioned municipal bonds. How do you make sure the governors don't use that money to fund pension funds, pay back bills like in Illinois? They need money for everything. Why would it go for infrastructure? It hasn't for the last 10, 20 years. Why would they change now?
Well, you would have to mandate it. Of course, you know, like people say, the devil's in the details. But you would have to mandate it that these funds could only go for infrastructure. You could put a pretty good team together of union operators and industrial people to oversee this.
So, Marthin, when we talk about just how bad things have gotten as to why we're having this discussion about how to address the problem here this morning, the cover of the New York Post, welcome to hell. Here in New York City, it's the day commuters have been dreading the massive summer repair project at the nation's busiest train station, Pennsylvania Station, otherwise Penn Station, kicks off what New York's governor has called the summer of hell for commuters across the region. Is this symptomatic, Marthin, of the transit problems that we're seeing nationwide?
You cannot continue to ignore rebuilding the infrastructure. If you have a roof on your house, you can patch it for just so long. It eventually has to be replaced. And we have been ignoring the infrastructure for a very long time. And everything is coming together now. It's perfect. Interest rates are very low. This is the time to invest in the infrastructure.
It seems the way to get legislators' attention is when it affects their constituents, and the constituents then see them at town halls and say this is an issue. One of the things that's so interesting about this American Society of Civil Engineers report is it says that from 2016 to 2025, each household will lose $3,400 each year in disposable income due to infrastructure deficiencies, and that's because when there are those infrastructure deficiencies, things like surface infrastructure, surface transportation problems, businesses end up passing those costs on to consumers, right? So with tax reform seeming to be stalling right now behind healthcare reform, what other ideas do you have to sort of get some of these infrastructure projects started? Where else could those funds come from?
Well, $500 billion is a lot of money to get started with, get you going. What you have to remember is that a good portion of the overall infrastructure investment is in wages and salaries. Those salaries get taxed. So the taxes come into the states and the federal government as a result of creating these jobs. And obviously people with jobs buy things, create an entire bootstrap operation to get the economy going in good paying jobs. And I think that's essential.
One of the ideas that's been floated is what they call asset recycling, where you take an existing asset like Indiana did with their own turnpike, use that because it has a revenue stream that can be used for things that aren't going to pay for themselves, like a lot of the transit systems we have in this area. Port Authority, you can extract upwards of $47 billion to pay for that $25 billion gateway project. Are those ideas beginning to percolate, using existing assets as a way to leverage?
I believe so, yes. Anything you can do to generate revenue is going to be very friendly to
well, it's a sensible idea, and Leah mentioned the pressure on the consumer, but if you look at the consumer doesn't want to pay tolls. The same report that we've been referencing cites that of the 614,000 bridges in the United States, 40% are past their 50-year intended window. But you don't want to push the imposition onto the consumer to stick out a $5 bill or a $10 bill every time he or she goes to work in the morning.
No,
so these ideas are sensible.
Easy pass, like credit cards. You don't feel the pain.
You don't feel like you're using it.
Exactly. All right, good stuff. Marthin Tuchman, thanks for presenting your plan here.
Thank you very much for having me.
Good to hear it.